All right, welcome to Peace of Mind Radio Podcast, the second version of this. That's Aaron McAndrew, that's Eric Douglas. And the reason we're doing it twice is because our famous or infamous, however you want to say that, producer, infamous, is that right, infamous? Yeah, producer forgot to make a change on the cameras. But he's going to say it's only because Aaron, who has a brand new phone sitting in his pocket, didn't allow us to use it for the first several. So anyway, he pulled it out, tried to sneak it out, and we're like, oh, you got a brand new phone. You're going to hook your phone up. So anyway.
Didn't allow. I mean, nobody even asked.
You didn't volunteer either. Now we're going to drain your battery and see how you like it.
Right.
All right, so anyway, today we're talking about market corrections. This is an interesting topic. It's probably pretty relevant depending on when this thing airs, because this is sort of all the topics that I've been seeing, especially the little news blips that come across my phone, is, pundits are out there saying, we're due for market correction, and that's kind of what we're starting to hear, because the markets have been bumping around these all-time highs for the last, since February we had the correction in February of 2020. So let's say middle of the year, we started bumping back on all-time highs, and it's been that way for about a year now, 12, 13 months. And so here comes the conversation of, are we due for market correction? So what we thought we'd do is just sort of walk through, A, what is a market correction? How is it classified? And then B, just sort of what our thoughts around the different types of corrections. What do they mean? How long they last? Should you do anything during a correction? How we educate clients around how to act what you should be doing around market corrections. So we'll just kind of round robin those topics. Mm-hmm. Yeah. So Eric, once you start off, since you were getting ready to say something, go ahead and say that, and then explain how do we classify a correction?
Well, typically a market correction is about 10% or more decrease in the value of an index. Now, what's funny is you hear so many market prognosticators talking about, we're going to see a 10% change in the market. That's going to be a correction. How do you define the market? And typically what most people look at is the Dow Jones Industrial Average or the S&P 500, something like that. So you're typically looking at one specific index. And yes, they do typically fall in line with one another, although not exactly. But it's important to note that just because there's a correction or a drop in the market of 10%, that doesn't necessarily correlate to everyone's portfolio, which is how obviously we talk about risk and making sure we're putting the proper amount of risk within a client's portfolio. But just the actual definition of a correction is generally about 10% decrease in the markets.
Yeah. So one thing that we often see or hear is that people don't really understand the difference between a correction and a recession, because it's a 10% either. So it's 10% correction in the market. If the market is 10% decrease over a quarter, it's considered a recession. So there's a distinct difference between the two. And the one thing I couldn't find, I tried to research it before this, was how long it takes to recover after you have a 10% correction in the market over a quarter. Which is considered a recession, but I couldn't find that number, so we don't have that particular number.
Yeah, and that all honestly depends on what's causing it. What's causing the correction? A correction could, just last year, a correction could happen just because of news that's being put out on, about something that may or may not happen, or a lot of times during election periods we see corrections happen because people get scared about what's going to happen in whatever direction or not. In terms of recession, most of the time there's something that's economically driving that to last a longer period of time. A correction could happen it did almost. And last year it happened overnight, basically.
For
so,
sure.
So that correction and recession completely two different things.
That was the point.
Corrections are definitely far more short term. Recessions are going to have obviously a lot longer length of time that they're dragging down the economy, dragging down the market.
Yeah. So here's one thing that is really the difference between what I don't know if this is a technical term, but what they call a fundamental correction and a non-fundamental correction. Now, what do we mean by that? Fundamental correction means that there's something in the economy, some area in the economy, some statistical data that is causing the market to sell off. So, i.e., back in 2008, right?
Yep.
That was a fundamental correction because we had a real estate issue, and so that was a fundamental correction. We've had other corrections that are non-fundamental. That means that the market corrected for really no fundamental reason. It just corrects because the market's been bumping around all-time high, and you have a bunch of sellers that wind up selling, taking capital gains, and so they'll take capital gains off the table, and you'll wind up in a recession. So there is a difference between the two, right?
Yeah.
There's definitely an added, layer of momentum or volatility that occurs in the market as well. So if you start seeing a little bit of an influx of sellers, leaving the market, well, that, happens, there's a domino effect that occurs, right? And so you're seeing other sellers that enter the market trying to get out of the market because they saw, oh, well, what do they know that I don't, right? And so there's a little bit of that occurs as well when you're looking at a non-fundamental correction that occurs in the market.
Yes, I would also say that the non-fundamental corrections. Now, I did find this, that one statistic said that a non-fundamental correction, meaning there's no economic data that's causing it, but a non-fundamental correction, the market corrects itself on average 45 days after the correction has happened. So once the market hits 10% on the negative side, it within 45 days, historically speaking, it will correct. It'll correct itself. Now, I will say that one of the issues that our producer is being hilarious. It looks like one of the phones is kind of running out of juice here, but yeah. So, but interesting enough, what I think we're seeing now is that we're seeing non-fundamental corrections more frequent, or they'll happen quicker, only because of social media.
Yep.
Because the word gets out. Like 20 years ago, we didn't have Twitter and Facebook and everything else. So what you would have is you would just have the data that came out of the newspaper, right? Or what you're seeing on. Mm-hmm. I think maybe CNBC was around, but basically you would have very few outlets that would give you the information to say that the market was selling off.
Yep. And now with phones and everything being digital, you were just talking about it a minute ago, all these different news bloops that pop up on the phone, and you got all these notifications and stuff, and somebody comes out and says so-and-so who predicted the 2008, who predicted 2001 as predicting by the end of the year this has happened, which causes nothing fundamentally, but it could be causing some people to panic or think I need to get out ahead of time just because we are at all-time highs. So.
Yeah, well, and I think one of the things that Eric brought up, Eric, it's been, I don't know, maybe 2-3 months ago, we did a podcast, one of your podcasts you came up with, and it was talking about the percent of headline news that was positive versus negative, and the overwhelming majority is negative. So everything I see on my phone, I guess I'm used to it, and I kind of know that the market's just going to give certain headlines. But really, everything that comes out, it's almost always negative.
Yep.
It's very rare do you ever get something positive. So it's just that kind of information that comes out that I believe sparks the non-fundamental corrections more frequent than. I don't have the data to support that, but I just got to believe that happens. At least that's...
Well, we shared some of the data that did support that there was an overwhelming majority of headlines that occur in the financial news media that are just dramatically negative because what's the old news axiom? If it bleeds, it leads. Right. That's no different in the financial news media or social media or really anywhere that you're trying to get eyeballs. Positivity doesn't really bring the eyeballs nearly as much as negativity does, and people are going to be more drawn to negative headlines. So, I mean, even today, I mean, we still see it. Hey guys, guess what? There will be a market correction in the next year. I'm telling you now. Throw me in the market prognosticators, but they occur about, you said about every 14 months.
Every 14 months.
About almost every year, pretty much every year, you're going to see a little bit of a market correction, about a 10% dip in the market. Most consumers probably won't even notice because to your point, they kind of take care of themselves or correct themselves within about 45 days.
Yeah, so what's interesting is when you, most clients that, I'd say the overwhelming majority of clients that we have look at their statement once a month. So they look at their balance once a month. And so most of the time these corrections happen either during that month or at some period beyond what a statement will cover, meaning it happens somewhere in either the beginning or the end of a statement. And so they see their balance go down a little bit, but they don't see where it really went down to 10%. And by the way, I say 10%. If the S&P 500 is down 10%, that doesn't mean a blended portfolio is down 10%, by the way. Right. It just means it could be down some percentage of that. Typically, it's down. Not always. Sometimes it may not even have to be down.
Depends on your risk tolerance in your portfolio.
Correct. Yeah, that's right. So there's all these different factors. But now, if you own the S&P in your portfolio, that would be down the 10%. But it doesn't mean your entire portfolio is. So,
well, it's also worth noting, too, just to expound upon that a little bit. When we talk about so many of these corrections, I mentioned before, we're usually looking at the Dow Jones or the S&P 500. Well, if you build a diversified portfolio, you've got small cap in there, you've got mid cap in there, you've got international in there, you've got some fixed income. So maybe one portion of your portfolio that's tied to the S&P. Usually, you're looking at kind of your large cap, growth and value stock funds. You're going to have a correction on that side of your portfolio, but you might have something completely different happening over here.
You mentioned something there, though. I think we should probably talk about why it's a good thing, maybe. Like why? So you said clients look at our statements maybe once a month or once a quarter if they're getting quarterly statements or whatnot, and kind of just trust the process. And here it is, and we're going to look at our account. Why do you think why is that a good thing that clients make? I'm not saying that checking up on your account is only 4 times or maybe once a month or whatnot is 4 times a year or once a month or whatnot, however you get in your statements, is a lot of times a good thing. Why do you think that is?
Because it's a very good thing, because if you were to look at this every day, and I have some clients that do, it would drive you absolutely nuts. I mean, here's the thing. We're in this business every day. It's what we do for a living. I couldn't tell you what the market's doing. I got something on my phone this morning that said the market was up, pre-market up 200. It could be down 500 or it could be up 500. I have no idea. And it's, what time is it, Mr. Producer? 3 o'clock, 3:30? I don't know, somewhere.
24 and the market's up 92.
Okay, well, the market's up 92, whatever. It's like 2:30. But I really haven't even had a chance to look at the market. I just don't look at it every day like that. If you did, it would drive you crazy.
Yeah. And then on top of that, trying to apply logic for what happened during that day or what's happening intraday throughout the day, it's almost impossible to apply logic to what occurs in the market on a daily basis.
And then what oftentimes happens when you start looking at it like that and you're seeing, let's say there is a series of 5 down days in a row, you start looking at it and you start not feeling good about continuing to see the market go down or your account go down or whatnot, and then you start making emotional decisions.
Yep. That's exactly right.
When they should be fundamental and stick to your plan. You start thinking about maybe selling things or getting out at the wrong time. So just wanted to make a point that is what you brought up earlier about people checking their statements. That's actually a good thing.
No, it is. Yeah. No, it is. Yeah, and so I guess that's the point of market corrections. And Eric said it. The odds are we're going to have a correction sometime over the next 12 months. It's been, Mr. Producer said, it's been 10 months as of this month, I guess starting in September, since we had a correction. They happen about every 14 months. That'll tell you sometime over the next 12 months, we're probably going to have a correction. But just because you have a correction doesn't mean that you try to adjust your portfolio to anticipate a correction. We don't do that. And certainly we're not going to make adjustments during a correction, because that's the worst thing in the world you could do, because, again, most corrections are non-fundamentally based, meaning there's no market or no economic data to support them. And they're typically about when you have them, about every 45 days, they've corrected itself. So there's no way to go and make adjustments in your portfolio to try to time the market so that you come out ahead. It's just too difficult to do that. And so we just, again, back to your point, as long as you've got a good financial plan and you know what you should be doing, just continue to do what you're doing and know that these corrections are going to happen, and only look at your statement once a month or something. Yep. If you do look at it every day, that's fine. Just don't make an irrational decision.
There's an old saying in our business, and I don't think it's even credited to anybody, but there was an old statement that I've heard numerous times where the best investors, or the investors that have the most performance or the best performance, are the ones that lost the password to their online account because they can't go in and check everything every day.
Yeah.
Because that leads to the emotional decisions that you see. Oh, my account's down 4 or 5 days in a row. What's wrong? I need to do something. And there's that panic that sets in, and you just can't let that creep in when you have to take a long-term approach to your investments.
Yeah. Yeah, so here's in a nutshell, when it comes to market corrections, yep, you're going to hear it on the news. And, the pundits out there are going to say, you're going to hear some of them go, we're going to have a correction, we're going to have a correction. Yep, you're probably going to have one. Odds are they're going to be right. It just depends on when when it actually happens. And then they're going to get on TV and pat themselves on the back and say, well, I told you it was coming.
Hey, I'm going to go on record now and say that it's probably going to rain in October. That's what I stole that from our producer here.
Yeah, you did. You did.
But you know what? If it happens, hey, I'm right. I told you it was going to happen.
Yeah.
And if it happens, and if part of your financial plan is that you're making systematic contributions to that same strategy that you're in, and that strategy's down, then you're buying at a lower
discount.
Yeah, you're buying at a discount. You're buying at a lower cost. Then when that correction comes back and it recorrects itself and we get back up, you now have owned more shares of the investments that you have, and allows you to accumulate more.
Yep.
It's also, and I'll expand upon that a little bit as well, because one thing that doesn't really get much notice or much press anymore, when you talk about how quickly we come out of these market corrections, one major reason that occurs is because if you still have a job and you're contributing to your 401k, what's happening every single month when you get paid? A portion of your paycheck is being invested. You're buying the lows, or you're buying the corrections. That did not occur to the degree that it occurs today. That did not happen even 10 years ago. So when you look back and see market corrections from 20, 30, 40 years ago, we get out of them much more quickly today because, one, we have a rash of information that's available on social media and other news outlets, but you also have just a far greater percentage of citizens that are contributing to their 401ks on a biweekly or a monthly basis that just didn't occur a generation ago. So because you're having that automatic investment that's occurring every single month, that actually kind of helps to draw us out of corrections a little bit more quickly than how they used to come out.
Yeah. Yeah, so here's the sort of, to kind of wrap this one up. Market corrections happen. They happen. You just know that they're going to happen. They're going to continue to happen. You just wait them out. If there's a fundamental correction, it will correct itself over time. We may be a little bit longer getting out of it, but it'll correct itself over time. So just don't make an irrational decision. If you have questions about market corrections, or you are worried about it and you want to talk to us, come meet with us. We'll be happy to meet with you. Be happy to, if you want to call us, phone number is 502-200-5210. And you can hit any extension in there and you'll get a hold of one of us. You can come see us. We don't charge for initial meeting to sit down and chat with us and find out what we're all about. If you want, I don't know if you just want us to reevaluate where you are to make sure that you're well positioned if a market correction happens. Be happy to help you with that too. So anyway, thanks for watching, and I'll let Eric sign us off.
Yep. If you're watching us on YouTube, click the red button in the corner to subscribe. Be the first to be notified whenever we drop any new content. If you're listening to us on Apple Podcasts, if you could leave us a 5-star rating, we would greatly appreciate it. Throw in a little bit of a review as well. And yeah, thanks for listening.
Have a good week.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.